Welcome to the Jay Martin Show. We are here in the remote studio again. I'm spending the month in Indonesia with my family. Today, my guest is E.B. Tucker, crowd favorite, and I always enjoy speaking with E.B. We talk about SVB, we talk about Signature Bank, we talk about the bond market, and most importantly, what might happen next. E.B. shares his number one piece of advice for the moment, and I guarantee it's not what you think it's going to be. As always, there's a link right beneath this video where you can subscribe to my weekly newsletter. I publish every Sunday. I love writing it. I would love to have you join the team. Hit that link below. You'll hear from me every Sunday. Now here is E.B. Tucker. Enjoy.
This is Jay Martin.
All right, E.B., it's good to see you. Welcome back to the Jay Martin Show. Thanks for making the time.
Thanks for having me.
My pleasure. So let's start with Signature Bank and SVB. And my question for you is, from your perspective, why did those banks fail? And do you think they're a domino for something else in the near future?
It's amazing. As you know, I don't have you send me questions in advance. I'm unlike probably anybody else that I feel sorry for your assistant. I said, don't send me anything. And it's funny you asked about this. My newsletter goes out tomorrow. It's ebtucker.com, and I'm writing about this exact thing because the SVB collapse is actually very simple. It's confusing if you look at the headlines, but it's very, very simple. What happened is that these guys thrived during the startup scene because money came pouring in, and the startup guys put it at the bank. Very normal.
Yeah.
And then the bank took that money and they bought tons of mortgages and treasury bonds and all these things that are really good. You know, these are good things to buy. But the problem is they have fixed rates of interest, and then the Fed comes along and jacks up the interest rates like a pawnbroker. I don't know if you've ever been to a pawn shop before, but I've been to a lot of pawn shops. It's really fun. And they jacked up the interest rate, and then all of a sudden these fixed rate bonds, 3% mortgage. Now the mortgage is 6.5 in the market, and that bond is worth a lot less. And then they go to sell these things, and the decline in the value of these bonds was bigger than their entire capital base. So the bank is insolvent. Poof. And I'll tell you what's crazy, and I have this in my newsletter. All this stuff was right in their filing. It was all right there. It was sitting right there. So anyway, so it's last year, I don't know if I think I told you this. The Fed is going to raise rates till something breaks. That's the deal. They're going to raise rates till something breaks. Now, what I say is make sure it's not you that breaks. That's number one, most important thing. But people would say to me, well, is it, BlockFi? Is that what they meant? Nope, that's not what they're going to break. Is it FTX? Nope. I'm talking like if they keep this up, they'll break Japan. I mean, they'll break a country. So this is just there's probably another 700 billion of the same type of problem. The problem in SVB wasn't that big, by the way. I mean, you're only talking like 20 billion in loss of value there. It's like sounds like a big number, but it's there's about 30 times that sitting at other banks. Now, not every bank is going to be insolvent. It's crazy if you're running out and taking your money out of Wells Fargo. You're kind of nuts to do this. I mean, you're no more dangerous. They're no more dangerous to you today than they were a month ago. It's about the same level of danger. But that's what happened, and I think people should see that. I've done my best to write that so that aunts and uncles and neighbors can understand in layman's terms. But that's what happened, and it's a consequence of the Fed. It's nothing to do with startups, by the way. Everybody's like, even my business partners on the boards. I get on these board calls, and the first thing they want to ask me about is some news topic. It's unbelievable. But these guys all thought that it was because of the tech layoffs. Nothing to do with that. Nothing to do with that. It's only a consequence of the Fed's radical change of course with its interest rates. I mean, radical. Like you look at this thing on a chart, it's just 20 years of down and then 6 months of straight up. Something's going to break.
So to summarize, like they borrowed short, they invested long, they bought long duration T-bills. I want to dive into the the nuance of how a bond functions just for a minute. But first, can you pick apart the finger pointing at the tech sector a bit more? Because yeah, we're seeing tons of that, right? Either pointing the finger at tech companies or at venture capitalists. What's at the root of that animosity, and why is blame being passed that direction?
Well, I mean, I don't know. I don't know if any real blame is. I mean, Silicon Valley is a huge supporter of Washington, of big government. I think you know that. I mean, it's massive, and so the average account, according to Seeking Alpha, the average account at SVB was $4 million, and the average account at one of the major banks is a lot less than that, right? Because there's a lot of people that work all day long on a roof or something, and they're really concerned about keeping enough money in their account so their debit card works at the convenience store, right? They're not $4 million in their account. Okay, this is big accounts, right? These people are the epitome of a group that you would think doesn't need a bailout. These are always the people that are trying to push things in our face about how we need to be so altruistic. This is what's so funny. And so then the first call they make is straight to Washington, right? Hey, you're going to fix this, right? We don't even know what happened. I want to make sure I get my money out of there. I got jet fuel to buy. So anyway, so I think people, they're saying things about this crowd, but I don't see any real action. If you notice, the talk out of Washington is like, no, it's not a bailout, and taxpayers aren't going to pay. We got a committee. We're going to put a committee on this, and they're going to investigate. And 7 or 8 years from now, they're going to definitely figure out, and we're going to really stick it to them, okay? Especially if they didn't give us any money, then we're really going to stick it to them, right? So anyway, so forget about all that. But so I think people should always be wary of people that are rousing up your tension towards something, right? So I mean, if they're stirring up, this is the tech sector. Well, I'm suspicious. I mean, the thing is much bigger, right? I mean, the tech sector had a direct main line to easy money policy, right? So like with 0% interest rates, any tech idea works. I mean, it's a really low bar, okay? And so the tech sector made so much money because you had money continually coming in looking for an investment home that could generate more than 1% return, because that was your threshold. And it was 15. You and I both know people that kept raising money at higher and higher valuations. There's no actual money. It just keeps stepping up the value. Now, the first part of your question, I think, is more important at this moment, because it's dawned on me that most people don't know how bonds work. And it's really simple how bonds work. So if you take $1,000 bond and it has a 3% interest rate attached to it, that means you pay $1,000 for the bond and you get $30 a year in interest. All right, that's a 3% rate of return. $1,000 bond, $30 of interest, and then some number of years later you get the bond back, the $1,000. You get that back, right? But the purpose of the bond is that the 3% is that's your rental income for your money, if that makes sense. All right, that's how it works. And you by giving that $1,000, you decided that XYZ corporation or the U.S. government or whoever is pretty safe, and I'm going to just get 3% for that. And collectively, by all these people making that decision, you riskier companies have to pay more, right? Because they might not pay you back, so they got to pay more. Okay, so what happens is that you buy that $1,000 bond, you're going to get your 3%, your $30, and then the Federal Reserve jacks up the interest rates to 6%. So the same company that you bought the bond from has to sell some more bonds. It's very normal, and they have to pay 6% now. So the next person that comes along is going to buy a $1,000 bond that pays 6%. I mean, $60 a year. Now you're like, wait a minute, I got the same bond over here. It's only paying me $30 a year. Well, yeah, well, guess what? I'm only going to give you $800 for that bond, right? Because it pays less, so I'm going to pay less for it. Okay, so I'm going to give you $800. Wait a minute, I paid $1,000 for this bond. Yeah, well, it's only worth $800 because I can go get a new bond that pays 6%. This is twice as much. I mean, come on, it's crazy. So this is how the market works. And the problem is that you have a committee of people, gentlemen and ladies for the most part, that are setting the price of these bonds, when in the past, the people that were actually buying the bonds decided who was risky and who's not. I mean, imagine you know what a bail bondsman is, right? It's like if you get in like a fist fight or something and you're drunk and you go to jail, you got to get a bail bondsman. So the bail bondsman takes a look at you, and you know, you look like a pretty tough guy, right? You get the shaved head thing going on, and they're like, you look like a flight risk. Okay, so I'm going to charge you, like, you know, a lot of money to bail you out of jail because you might take off. I don't know where you're in Southeast Asia before I can find you again, and I'm on the hook for. Okay, and then they say, this is E.B. Tucker here. This is jacket man. Look at this. He ain't going anywhere, you know? So we'll charge him less. Okay. That's like, they're doing a risk assessment, right? They're right or wrong. They're doing a risk assessment. And that's how it works. But that's not how it works anymore. So like when the committee puts the rate at 0, then you have companies coming along that don't even make money. They don't even make money, and they get to borrow for like 2%. It's crazy. And then all of a sudden, because it got out of control, they got to jack up the rates. And here is somebody that bought the $1,000 bond at 3%. It's now worth 800, and they're stunned. That's Silicon Valley Bank. That's what they did. They did the same thing on a huge scale. It's the same thing. And it's not crazy that they did it, because it's what the bank does. They loan, you put the money in there and they turn around and loan it out to somebody else. The problem is that most banks, most people hedge. They hedge. We don't have to get into that, but they hedge. They protect themselves against fluctuations in interest rates. You know, if the interest rates get crazy, then they have an insurance product protecting them against exactly this. If Silicon Valley Bank had done that, they would still be in business. And I know, you know, we're kind of talking about this, but I just want to assure people that it actually is so simple. It's so easy. You know, it's really, people get intimidated by the big numbers and jargon and all these things like that. But it's really just, I grew up, my dad had a furniture store. And so I learned when I was a kid that selling a recliner, you know, for $400 or something, if you could figure that out, you know, you could figure out stock analysis, you know, on a big company. It's actually the same thing. And it's so simple. And I think people, when I write my newsletter, the Tucker letter, I try to explain to people, I'm just going to tell you everything I know. You know, I'm just going to tell you the way I learned it. And eventually you're not even going to need me anymore, because you're going to be ready to do it yourself.
I love that. By the way, I am in Southeast Asia right now, so maybe I'm on the
lucky guess.
EB.
Yeah.
Okay, so a couple things I want to pull on here. Thank you for that explanation, by the way. That's exactly what I was looking for in terms of bond performance, because I think it's something that gets thrown around a lot. Rates go up, bonds go down, but people don't actually understand what that means, and that's what that means. And so just to make sure I am with you, the consequence of that is that SVB owned a lot of long duration bonds that have come down in value. So they're essentially underwater on their long-term assets. And when they had the cash call for, so how does that then function when you have the tech industry making the cash call, saying, look, you know, operating costs are going up, profits going down, we need some cash. So they're pulling cash out of SVB while they're underwater on their bond holdings. What is that dynamic? How does that dynamic?
Well, so it's not really the tech company's fault. I mean, the tech company put the money in the bank so that it could go to the bank later and get the money out. You know, it's kind of like a rainy day fund. But yeah, and you and I both know people in this scene, and you the last 6 months, the common lingo was, well, we have a lot of runway. You know, we have 2 years of runway. That's what all the tech guys were saying, is that they raised enough money in 2021 that they had a couple of years of operating capital stuck aside in the bank. And so as they started saying, yeah, we need a couple $1 million, we haven't raised any more money, the market is really tough, we thought we would go public, we can't go public, we have a lot of tax to pay, whatever the case may be, they come and start getting this money. And Silicon Valley Bank, you got to remember, their deposits went from like less than 70 billion, like 65, 68 billion, something like that, to 173 billion from the end of 2019 until last week. So, I mean, that was a really big, that is almost 3 times the deposit base, because if you recall, uh, every company with a pulse was raising money in 2021. So
Yeah.
like, if you had an idea and a laptop and a website, you could get funding in 2021. So I mean, it was a low bar. But what Silicon Valley Bank would have been fine if the Fed didn't raise rates, hypothetically, or if the tech companies kept expanding, raising more and more money, depositing the money there, they would have theoretically been fine. So it wasn't like they did something crazy. You know, their mistake was, if they had hedged, if they had like, if you notice, I put a picture in my newsletter of the actual snippet of the filing. Okay, about 10% of the bonds they bought were variable rate bonds, and those did fine. Like
Right.
in Canada, you have a variable rate mortgage. So that means that as interest rates go up, your payment goes up. And what that means for the bank is that the bank is like, hey, we're not going to loan you money, and then the interest rate goes up, and then we're stuck with this loan that's not performing. You're crazy. But in the US, most of the loans are fixed rate loans, especially the smaller loans. And so in the US, if you take a loan for 3% during COVID, and then the interest rates go to 7, I mean, the bank is massively, whoever owns that mortgage, I mean, it starts out being the bank, somebody else eventually, but whoever owns that mortgage is massively underwater, because they paid, what they paid for it, it's now gone down substantially, because nobody wants 3% rate of return when the going rate is 6.5. So that's the problem, is that Silicon Valley Bank goes out to sell those bonds to get capital that it needs, because the regulators say you got to keep this much money in the bank.
Mm-hmm.
And they say, well, we didn't think we'd have a need for that, and so they need to sell those things, and then they go to sell them. Like, you go to, remember the $1,000 bond that paid $30 a year, you go to sell it, and the guy says, I'm going to only give you 800 because it pays half the interest of the other bonds.
Yeah.
And I think people need to understand that this is not like 2008, when people weren't going to pay the mortgage. It's very different. I mean, the bonds that Silicon Valley Bank had, people were paying those. I mean, it wasn't like they weren't performing. It was just that the interest rate dynamic had changed drastically, and they had left themselves exposed to that.
Yes. Okay. So thank you for that.
But Signature Bank and the other and Silvergate are different, by the way, slightly different. I mean, they kind of had like a different set of problems. Like they went totally crypto. I mean, that's like a whole different animal.
Okay. I want to pull on that thread in a second then. Yeah, I do actually. Yeah. Prior to that though, the problem that SVB, the Signature was sitting on with these long duration bonds is duplicated, dozens of times throughout the United States, including, the largest holder of them is the Fed itself. Another very large holder is the FDIC insurance fund that exists to provide bailouts or financial support to depositors in banks like Signature. They're holding the same asset. It's underwater just as much. They're in the same situation, no?
Yes, but they have a fancy piece of equipment called the printing press, and Silicon Valley, SVB, did not have that.
Yeah. Okay. So fair enough. And that's my assumption. Fed's not going to go belly up holding its own bonds, but dozens of other banks might, right? SVB.
Well, okay, look, okay, but here's the key piece of this that I want people to understand, is that if you're a bank and you intend to own the bond until maturity, like when you buy the mortgage, you say, I'm going to own this mortgage for 30 years. It's going to pay me the whole time. You don't have to report on the change of value.
Yeah.
The problem was not that. The problem was that they needed to sell. So the other 700 or 800 billion that's sitting there in the same scenario around the other banks, it's not really a problem unless those banks need more money, and then they have to sell the bond. So it's kind of like your stock portfolio. gets hammered, you didn't take a loss until you sell it.
Yes. So those banks
So
might be in the same situation, but until they get their own unique cash call, it doesn't matter. And
yeah,
that could occur at any time. We wouldn't know. We could speculate, but we don't know what that might be.
if Silicon Valley Bank had sold stock in Q4, for example, like stock, not the bonds, if they had just said, "Hey, we're going to issue another million shares of stock or whatever," and rake in $1 billion to top up the balance sheet, they would have survived longer
Yeah.
because
Yeah.
they did not intend to sell those bonds that they sold. That originally, it says on the balance sheet that it's called hold to maturity. I have a picture of this in my letter. It says, it has other bonds that are meant to be sold, but like these bonds, it says we're not going to. I mean, obviously they lost money in the other bonds too, but it's my point is that if Regions Bank or something has a few of these bonds, they're underwater, but they're not having a capital exodus in the other side of the bank.
Yeah.
It's not necessarily going to be the same problem.
And okay, another rookie question for you, EB. Had they held that bond to maturity, would they have been made whole on their purchase price?
I think so, yeah, because at the moment, the U.S. government has not indicated that it's going to not pay interest on the treasuries, and at the moment, the mortgage defaults are not necessarily at a level where people are walking away from mortgages. So, I mean, it's possible that changes, but as long as that were to stay the same, that means people would make those payments the whole time, and they would get 3% rate of return, whatever the rate was on those things for however many years are left, and then it's over. Or if people refinance, but they're not doing that right now. But if they refinance, the loan comes due, they would get all that money. It wasn't like necessarily like an impaired loan. It was a totally rate risk. That's the whole deal. It's exactly like if you live in Surrey or somewhere and you borrow as much money as possible to put yourself like an above ground pool at your townhouse, and then the interest rates go from 0 to 5. You can't even pay it, because you're like a nurse or something, and you got a 1% raise, but your mortgage rate quadrupled.
Mm-hmm.
There's no way you can make that happen. You just so it's not like you lost your job, right? You just had your interest rate sensitivity, and you the problem is that you never thought about it, because since you were 20 years old or something, the interest rates have been going down, so it's working for you the other way.
Yeah.
The payment kept going down. You were like, this is amazing. It gets cheaper and cheaper.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. So then what would the hedge have been for SVB? What could they have done? Where could they have hedged that they did not?
Well, two ways to do it. I mean, one, they could have bought, variable rate debt instruments to start with, or they could have bought insurance against the rates going up, and these are just in the form of swaps. I mean, you can pull up the quotes on these things all day long. I mean, you can basically insure anything. I mean, this is, you can say, I want to ensure the Mexican peso doesn't go down more than 3%, and why would someone do this? Because say I'm going to build a high rise in Mexico City and I need to borrow $100 million, and I don't, it's going to take me a year and a half to build it. And I don't want to expose myself to those kinds of fluctuations in the peso while I'm building this building or something. I mean, it's totally sensible that people would do that. So but you have to pay for that. You have to pay. It's like an insurance premium, right? You have to pay. And then what happens is that the value of that insurance trades in the market. So as the rate moves, the value, you still lose money, but your insurance becomes worth substantially more, right? And so think of it like this: say you have 1,000 shares of Shaw Communications or something, and it's pretty stable, right? And so you're like, okay, this is a big amount of stock for me, and I want to protect myself in case the company has an unlikely bust, like if something happens and it runs into this like Enron situation. I want to protect myself against that, even though it's low odds. Okay, easy to do. What you do is you buy put options, which if the stock goes down, the value of the put options goes up, right? So what happens is you lose money on the stock and you make money on the put options. And that's what happens with when you have a bunch of fixed rate debt, is that you buy that type of insurance. So the debt goes, if SIVB had done that, what would have happened is they would have sold those bonds. They would have recognized a 15 or $20 billion loss. And then they would have sold the insurance at the same time and recognized a 15 or $20 billion gain, less any fees.
Okay.
And so they would effectively have netted those things out, and they would have protected themselves against that. And I don't know why they didn't do that. I mean, it's extremely common, especially when you're dealing with that kind of money. I mean, as you know, like as your life gets more complicated, your insurance people have all kinds of advice for you about things you need to do, and a lot of times they don't make any sense. But they tell you, like, look, I mean, if this happens and this happens and this happens, you're wiped out. And you're like, what are the odds of that? Pretty low, but it could happen. And who would have thought the Fed raises rates from 0 to almost 5 in 10 months, basically? Nobody would have predicted that.
No. And I want to spend some time on that, because if rates keep going up, what could be the next domino. Before we get there, though, you touched on, was it Signature being a different story and how that?
Well, slightly, yeah. I mean, so the crypto-centric banks really pivoted their business, to a different type of customer. I mean, the Silicon Valley, while it had crypto people, also was like heavy tech scene, and Signature and Silvergate positioned themselves as being like really the go-to crypto spots. And as you know, a lot of the crypto people, while they're still quite loud, have lost a lot of money. So those banks had a slightly different issue, with solvency. While the crypto market was hot, they were a place where people could use the banking system that were crypto people, and had crypto friendly kind of attitude towards that. And so that market is hurting. I mean, that's the crypto market is really hurting. There's people that definitely overcommitted to Solana coin, at $200, and it's not like it's zero. I'm just saying that they had a lot more money. They had a lot more on their phone, when they would show you their Samsung Galaxy 50 or whatever they've got, they would tell you that on this phone, I've got a lot of money. And then you would say, well, then how about you pay for dinner? And they would say, only if I can pay with Pizza Coin. And then, then you got to hear about it for 3 hours. But hopefully they'll just wash off into the ocean, and then, we won't have to hear about it anymore.
Okay, but similar dynamic, different asset. Their asset wasn't necessarily operating, or I guess cash balances in tech companies. It was just the price of crypto. People getting squeezed for a different reason. But
well, I mean, obviously they at some point have to turn that into money, and that was like quite difficult, Yes. I got a buddy who travels around with like 3 phones and a hard drive and all this. I'm like, what are you doing, man? I mean, honestly, like, get a credit card.
Right.
I mean, what, like, why not? Why not? I mean, who cares, really? Who really cares? Like, honestly, like, why do you need you got a whole suitcase full of that? It's just computer equipment. So it looks like you're going to blow something up. I mean, what are you doing?
Yeah.
Yeah.
All right. So, Biden came out a couple days after with some loud statements about how they were going to find out, who was responsible for this and make sure they were held accountable. Right. Um, as far as I understand, it's not really anybody who did anything wrong. Rates went up and consequences occurred. That's as far as I can understand this
Yeah.
situation. Do you agree with that?
I mean, it's well, the problem is that, we used to have a market in the US. A market, like a market is when buyers and sellers argue with each other and collectively determine the price of things by assessing the risk. And, if everyone starts thinking that you're a scoundrel, then people don't want to do business with you, and you have to lower your prices to incentivize people to do business with you. And that's what makes the capitalist system work. But that's not what we have anymore. So we don't have that system anymore. We have social studies class in middle school where we talk about that system. It's folklore, and we hear stories about that system, and we read books about that system, but we don't actually have that system anymore. What we have is a centrally controlled system that is inspired by capitalist activities. Okay, so that's very different, and there is no one to. Okay, so what are you going to do? You're going to go to the bank guys, and you're going to be like, you didn't hedge your debt portfolio, so we're going to put you in the gulag. I mean, I doubt it. I mean, my suspicion is probably they'll have some people, some heavily corrupted people investigate, and then they'll find some mid-level person that is a Trump supporter or something, and they'll barbecue this guy, on Capitol Hill, and get him there 3 days until he's exhausted and says that he just didn't care or something, and then they'll say, Trump did this or something, whatever. So I mean, let me just tell you, man, like I've been around. I'm not as young as I look. Okay, so I've seen this happen so many times, and people fall for it every time. They fall for it every single time, and they're going to fall for it again, and they're going to fall for it 1,000 more times until the system doesn't work anymore. Of course, I mean, eventually, the thing crumbles, but everything eventually crumbles, including me and you. But basically, the same playbook is every single time. We're going to find those weapons of mass destruction. We know they're in there somewhere. And so it's not a conspiracy. I'm just trying to say to you that try to ignore, like in my office here, there's no television, right? So there's no television. In my house, there's no television. I don't mean there's no television on the wall that I watch. I mean, there's no television. I mean, obviously I have this fancy machine, but this is a lot of fun. It's like the world's most interesting video game. But basically, I get to choose how I take in this data all the time. It's not talking to me. I'm reading this stuff all the time, studying and whatever. But the reason why I have no television is quite simple. Is because what happens is you create a massive distraction, and the distraction is messaging. Now, when I was a kid, my parents would say, they called television the programming. They'd say, "What's the programming on there tonight?" Remember, have you ever heard of this before? Think about it. Programming. It's very interesting. It's programming because it's designed and curated, to influence you and distract you. And what we have nowadays is we have this life that people live where there's not a minute of the day where they're not attending to some sort of external signal that's being sent to them. And when you do this all the time, you get very confused. And when you're very confused, you're much easier to control. So my suggestion would be, instead of worrying about, the MSNBC just sent you a text message telling you that Elizabeth Warren is really mad about the billionaires that got their money out of Silicon Valley Bank. I'm sure she is, because they didn't give her enough money. So I'm sure she's going to get to the bottom of why they didn't contribute more. But instead of worrying about that, you can study past experiences like this, and you can look around at what's going on, and it's really obvious to see. And it's not a conspiracy. I get really tired of conspiracy talk. It's crazy. It's not a conspiracy. It's just, it's just the way it works. I mean, this is how it goes, and there's always going to be this way. And the faster you kind of get hip to that, the more fun you're going to have.
Okay, I like that. Okay, where we should go next is into capital allocation. Presently, I'm always curious, EB, where my guests are putting cash, if they're putting cash anywhere, if you're waiting on the sidelines. I recently hosted a conference in Vancouver. Love you to come next year if you're able to. It's
by the way, I was going to tell you, I was there for 3 hours.
I didn't know that.
I mean, I saw you giving you did a great job. It was super professional. You're giving a talk. I was there for 3 hours. Then I had to go to a carbon conference in Texas, so I had to leave. I could only do the first 3 hours of the thing, and then I had to go to the airport and go to Texas, which, by the way, was in like a massive ice storm. It was really hard to get around. I mean, Texas, when they get an ice storm, man, I mean, you forget about it.
Yeah, right.
Yeah.
Interesting. Okay, well, that's awesome. So, if there was a theme, EB, that came out of that event from everybody that I interviewed, it was that the trade of the year, maybe the decade, is patience and defense. Right? Everyone's playing their.
Nobody has that, by the way.
Okay. Yeah. What are you doing?
Nobody.
What are you doing?
Well, I mean, I got to tell you, I really tend to not end up in a jam very often anymore. I mean, in my life, and part of it is because, like I was saying about the no television, you start, like last year, in March, I had a phone call with my property manager who I didn't like that much, how he's performing. And then I'm studying my stuff here, and I just said, you know what, I'm going to sell all my rental property. I'm going to sell it because it looks like the Fed's going to raise rates. I thought like once, right? Number one. Number two, the property manager's not solving problems for me. He's causing problems for me. Number three is that I own this stuff for a long time now, since the last crisis, and I'm getting totally tired of it. And people are willing to pay me like what I think is too much money for it, right? So it wasn't like I tried to outsmart anyone. I was just, that's my thought process. And so I called up a real estate lady, Julie, that does all my real estate stuff, and I'm like, sell all this rental property. She's like, all of it? I go, all of it. Sell it all. Send me the DocuSign. I'll sign it tonight. Get the signs in the yard tomorrow. I want it as fast as possible. I'll give you prices, and we're going to negotiate quickly with anyone. Sold all of it. All right. So ended up, with a decent amount of cash from that, and took that cash and bought a bunch of treasury bills. I mean, I talked about this last year. I don't think anyone knew what I was talking about, but I tried to explain to people. I in the summer, I started getting into the treasury auction, right? And I was doing this thing called laddering, where you're like 4, 8, 13-week treasury bills. Well, they went from like 25 basis points, which is like 0.25%, to almost 5. So, I mean, I had like a huge amount of money, just like rolling over. And then I told people after I did that, I said, you should go to a fish concert, because the fish concerts are really fun, because they're super talented, and it really distracts you. Like you can watch these guys jam, for hours. And, I went to see, I don't know, I must have seen half a dozen shows, and people were like, that's crazy. And I was like, you gotta do something. You can't stare at this stuff all the time. There's nothing to do right now. And that has proven to be right. Now, I've done some things. I mean, I thought you would like this. I got a silver bar here, I bought this yesterday because one of my really good friends, John Fisher, was on the phone with me, and I was like, send me a silver bar, So he overnighted the silver bar, but they're just fun to have. I mean, like this thing, you've had these before, but this thing is like, you put this in your office, right? Like,
yeah,
on the desk, and people come in and they got to touch it. And, so they got to touch it, and they got to, hang out, and it's fun. You bought that. So I bought some little bit more gold too, because the problem is you don't need that much gold. People get this all wrong, right? I mean, you don't need that much gold. People get way too much gold, and you're not going to really make money on gold. It's not like that. It's going to kind of protect your wealth. And so, like twice a year, I'll be like, how much gold, do I need? I don't have enough gold, so I'll get a little bit more gold. And people are shocked by that. I mean, they think that I would have like 50% of my assets in gold. It's not true. I mean, in my book, Why Gold, Why Now, I try to, I don't give advice in there to people, but I try to explain that there's a percentage that's kind of suitable in my opinion, and it's a lot lower than you think. So okay, I'm on the board of a carbon offset company, which is becoming quite large, and I've been spending a lot of time going to carbon conferences. That's why I missed your excellent conference, and I just went to Aspen Ideas. I just went to we're North American CSOs. That's the Chief Sustainability Officer. We're in Texas for the big conference there. And so I'm going to a lot of these things. And what I'm doing is I'm investing my time, which is very valuable, right? We all have a fixed amount of time that we can do things. And I'm investing my time there because the carbon market is not doing what the bond market's doing. The carbon market is doing quite well. And so I'm doing that, and that's turning into a big investment for me. And then another thing I'm doing, I am buying some stocks, just to be clear. In my newsletter, ebtucker.com, I've got what's called a trustee portfolio, and I've spent a lot of time. Like, people can read these articles for free. I've spent a lot of time explaining to people that you and I have a split personality, right? And inside of our personality, there's two parts. And there's a trustee, which is like a responsible, wise, seasoned manager of wealth. And then there's a gambler. And the gambler wants to do crazy things. He wants to like have a poker game till 3 a.m. and win the deed to your house. And these two personalities are part of us. And so part of what we've done that a lot of people haven't done is figure out how to be close with both of those personalities, and how to tell the gambler it's not a good time for you right now, and then tell the trustee, it's important that you have the wheel right now, because right now investing is a long game. It's a survival game. It's not a get rich quick game. And even if you have $1,000, it's still not a get rich quick situation, because you're probably not going to get rich quick. You might, but you're probably not. And so I have a portfolio in there called the trustee. I have a portfolio called the gambler, but there's nothing in it right now. But in the trustee portfolio, I'm actually building that portfolio to match the same portfolio that I'm managing for a trust, where I am the actual trustee. Legally, I'm responsible for a trust, and part of that trust is in stocks. And so I'm slowly building the same portfolio there. I'm just basically telling you what I'm doing in that portfolio. I think people would be surprised. Some of the stocks have done quite well in the last 3 months. I've got one company that is the largest provider of French fries in America. And if you've been to America, you know that French fries are a luxury item. We've cheapened our currency so much that the French fry is now kind of it's going to be an entree item soon. But anyway, things like that people would not normally think that's exciting. But for instance, the French fry company is up about 17% last time I checked since mid-November, and that is not bad. I mean, honestly, like that is not bad at all. We're doing a little bit of energy in there, big energy companies. Not the small energy companies. Warren Buffett is mostly taking control of Occidental Petroleum. The energy market is really interesting. You saw the U.S. this week approved a huge ConocoPhillips project in Alaska in the middle of a refuge with baby polar bears and stuff. And what that tells you is that everybody's mad at Biden for this. But what it tells you is that the U.S. knows it needs to continue producing reliable sources of crude oil because the green transition is not happening as quickly as anticipated. And oil usage in the developing countries is still quite high. So the only thing that I'm really not buying at the moment is real estate. I mean, I did buy a different house for myself, but I felt like it's a really good fit for me. You know, it's like a friend of mine designed it and stuff. So I called the owner, was going to sell it. I said, don't use the realtor. Let me buy it from you. And so I don't think that's like really an investment. I mean, your house is not really, I don't have a big house. You know, I always have a cool house. Like I always have a really cool house, but not a big house. And the reason why is because my lifestyle since I've been young has never been conducive to debt. So I've never been able to really have like the same type of buying power that you know. So you know, as my career's grown, you know, the houses have gotten cooler, but they people are always shocked. You know, they're like, thought you'd live in a really big house. But I'm like, what am I going to do in there? You know, it's just crazy. And also, they have no character. The big houses, a lot of times, have no, you know, so they're built in poor taste. So anyway, so I don't really consider, you know, that. But I do think when people ask me for advice, I do think you should have a cool house because what happened? I mean, I write, you know, so for me, you know, the space where I'm living is really important. You know, if I'm living in a homogenized stucco, you know, styrofoam, you know, house in America with columns and a cul-de-sac out front, I can't think straight. You know, it's too confusing. So I need to live in a place with lots of natural light and lots of glass and, you know, like a hip, you know, skinny pool out back. And I mean, you know, it's I like that stuff. You know, it's cool. I like architects too. I mean, architects will make a place for you that's cool if you let them, if you leave them alone. Just tell them to, you know, let them get to know you and then don't bother them too much. They'll build you a cool place. But anyway, so I encourage people to do that. And that's something you can do, you know, anytime. I mean, you can always invest in your space when you can't find other things to do and you need to distract yourself. You can do that and build yourself a sauna, and you know, you'll kill a lot of time and you might keep yourself out of trouble. I mean, a lot of people, they just can't stay out of trouble. They can't sit on cash. They can't. Everybody was shocked that I didn't take the rental house money and buy a bunch more houses. And I'm like, why would I have sold these houses and bought more houses? I mean, it doesn't make any sense. So it's like selling, you know, Tesla and buying another car stock. I mean, it's like, what are you doing? You know, it's the same thing. So anyway, the point is that I'm doing things like that. And so far I've, you know, been feeling pretty good. I haven't really had any problems to speak of. So.
I love that. Hey, okay. So love to buy a cool house or live in a cool house. Piece of advice, by the way. Look, I know you got to jump. So, but I have to pull on one thread. You said since you've been young, your life has not been conducive to debt. And I'm just curious what you mean by that.
You know, I never could get a mortgage, right? I mean, I could never get, I went off on this like unusual path that was unpaved and nobody was on it. And I was just a total kind of wanderer. And I wrote about this in my book that what motivated me was intellectual freedom. That's all I wanted. I mean, I was sent off to a reform institution when I was like 16, and then before that, I was at like it was a terrible adolescent period, and so it was really important to me as I started working to have intellectual freedom, and I quickly realized that the only way to have intellectual freedom was to have financial freedom, and financial freedom to me was a much smaller amount of money than to most people. You know, I was willing to live, you know, in a small place. I was willing to drive a really beat up car, I just didn't care. I was like, I can't, if I have a car payment, I'm going to be, someone's going to have to tell me what to do all the time. And I'm not going to like that. So what happened was, it was that when I focused on those goals, it worked out really well for me in the long run. Okay. But in the short run, nobody could make sense of me on paper. So anytime I would try to go and do something conventional, like get a phone turned on or something, they'd be like, we don't understand what you do, and I'd be like, well, I'm blogging and I'm doing some stock research and, I'm doing this and I'm going to Mexico to look at a gold mine and, I have a roommate and believe me, I'm good for the phone bill. And they're just like, it doesn't work that way. Do you have a pay stub? It's like,
Yeah.
So anyway, so what happened was I just was like blocked out of that, and even now, I mean, like, it's so funny because what happens is that everybody in the U.S. says, I got a mortgage guy. You got to talk to him. And I'm like, believe me, he's not gonna do anything for me. Not that I want a mortgage. I'm just saying this comes up. And so I indulge them. I say, all right, let's go talk to your mortgage guy. And then I get in there and the guy's like, we can definitely help you. And then so I start explaining to him what's going on and look at tax returns. And he's like, well, you got lots of money, but you should definitely use my money to pay for your house, not your money. Okay, so sure, what do you got for me? And then they come back to me like 2 days later and they're like, well, it's really complicated because you don't have a paycheck. And you only kind of pay yourself like twice a year or quarterly or something. And because I do it like a hunting for a buffalo or something, right? I mean, like, imagine if we lived in a village together a long time ago, me and you. So we would be the elder statesman. And I would say to you, everybody's looking a little hungry. We gotta go up the hillside and kill something. So we would go up there and kill a buffalo, and then we would get some helpers, some kind of beta males to help us drag that thing down the hill into the village, and we'd feed everybody, and everybody be eating for about a month, right? But you and I would eat like the heart and stuff. We would consume the organs, of course, but this would be my role. Okay. And so the way I've always operated is like, let me get enough to eat, so that I don't have to be going out to get something to eat every 4 or 5 hours or something. And I can focus on this stuff and take care of this or that. And then when it's time to eat again, I'll go get something. And so that's how I thought about money too, right? I was like, if you got to go to like the store where you work or whatever, like to the Subway or the dry cleaners or something, you got to be there for 50 hours a week, man. You can't do anything else.
Yeah.
You can't do anything. So I mean, you got to set your life up to where you've got a big amount of time to focus on things if you want to do what I wanted to do, And so my point is that the mortgage guy looks at this and he says, we can't be sure you'll be able to pay the mortgage because you have to make a mortgage payment every month, and you only have a bunch of money coming in every three or 4 or 5 months, And it's really, to me, it's like comical, right? Because I'm thinking, well, I guess you're right. I mean, it's like, but anyway, but I got used to all that. And then, what part of that is that you have to live within your means. And that's really hard for people. You have to live within your means. And once you get used to it, it's fine, because when I want to do something, I just pay for it. I just like, you just pay for it and do it, right? I mean, we'll take, my kids on a trip or something, right? And I'll be, where do you want to go? They'll say, okay, great. And so we'll book it for, 3 months away, right? And I'll just pay for the whole thing now.
Mm-hmm.
So you get into this mindset, and it actually works better because you're not paying for the trip after.
Yeah.
So anyway, I don't know. It's like it's not for everybody, but I'm saying for me, that's been my path. And once I accepted it, it made a lot more sense.
It's sage advice, man. It really is. And you're right. It's very difficult because debt is so seductive, right? You could have this trip now, right? Instead of in 6 months or whatever. Um, okay, look, we should probably wrap it up because I know you got a mastermind you got to jump to. So I appreciate your time, EB. Love to do it again and would love to have you at the conference on stage with me if we can make it happen in January.
Yeah,
Open
let's
door,
do
man.
it.
All right, awesome.
Yeah. And look, ebtucker.com. All right. It's brand new this quarter. People were bothering me for a long time to start writing again. I wrote a book, but that wasn't enough. They wanted more. And it's there, ebtucker.com. You can read it for free right now. I promise you'll learn something. It comes out every other Thursday at 9 a.m. Every other Thursday, it hits your email box 9 a.m. I don't bother you at all between those two things. And come learn with me.
I love that. I love that. Okay. ebtucker.com. Right now, a free newsletter every Thursday morning at 9 a.m. Weekly wrap up. What do you talk about, EB? What do people get from you?
Well, this week I'm talking about shark liver.
Okay.
So you have to go in there to see. But it's every other Thursday.
Every other Thursday.
Because it's because I travel a lot, so I got stuff to do, man. I can't be, I can't be coming to you too often because I wouldn't have anything to talk about.
Right. Okay. All right. Are you going to join Twitter? That's probably a question you get asked a lot as well. No.
Never.
No interest.
But the only place, here's the thing. The only place you can find my work is ebtucker.com. And that's important because I'm not going to be out. Twitter's like a pub. You go to the pub and you kind of like, tell jokes to your buddies and laugh and do all this stuff, but nothing really happens at the pub. And so Twitter is a place to make a bunch of noise, but I don't do that. I make noise directly to you. I'm sitting right here writing to you, and I'm not at Twitter. So if I'm at Twitter, I can't focus on this, because I'm sparring with people and telling jokes and goofing off. And that's my philosophy. I could be wrong, but that's my philosophy. So when you find me at ebtucker.com, that's the only place. I mean, I have a LinkedIn, but that's kind of like a digital business card. That's a bit different. But the only place I put my thoughts and ideas is ebtucker.com. That's it. That's the only place. And try it out. You might find that it's a higher quality way to communicate with me.
I love that. Okay, man. All right. Well, look, thanks again. I appreciate your time.
All right. Okay. Talk to you later.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.